So we move into corporation tax and the tax computation and administration. This is part one, several parts to this, and you may recall what I mentioned about CT and corporation tax, that for me it's the most manageable tax, certainly in terms of the computation itself. It's not difficult to make up the computation and score some marks, unlike, let's say, the IT comp, which has a number of different parts and can get a little bit complicated. So let's take a look at this first area and a sort of an introduction in one sense, because what we've got to talk about or think about is, okay, I've got a corporation, but what are its assessable profits under the UK CT banner? Well, first things first, yeah? A UK resident company pays corporation tax on, note, worldwide taxable total profits for an accounting period. So if you are classed, as we'll see in a moment, as UK resident and you have income in any country, yeah, then that amount of profits is going to be included in your TTP, bar none. Okay? Now, what do we mean by residency? So a company is resident for tax purposes if, note, it's incorporated, yeah, or it's centrally managed and controlled. Now, look at this area here. This is important. I've seen this come up on OT short form questions several times. The first bit's easy. You know, we know what incorporation is. Oh, I want to set up a company in the UK. Well, I just go to an agent and bingo, for £30, you're done. Okay? You know, directors, shareholders, etc., etc. But this second one is a little bit more tricksy, because we're talking about the actual running of the company. Note, central management and controlled. Now, under UK tax legislation, there's no specific definition of what central management control means. So to some extent, it's subjective. But at the end of the day, this rule, sort of an anti-abuse rule in one sense, isn't it, is sort of centered around the idea that HMRC in the UK, certainly for CT purposes, they want to catch companies that actually aren't incorporated in the UK, but are actually managed and controlled from the UK. Obviously, we know that people work in mysterious ways, businesses, corporations, etc., and certainly multinationals. So really, what HMRC are trying to do is to have this sort of catch-all net. Okay, so those are the two rules, and note that these rules about residency are certainly a lot less complicated than the rules that we saw within the IT section or income tax on the residency of an individual, you know, with the sort of automatic tests, with the ties, etc., reference to the tax tables. There's nothing to this rule, so it'd be a shame to lose the mark. We saw this in a short form question, or the marks, as it were, normally 2 for each OT question. Okay, so that's what assessable profits mean. Basically, worldwide, if you're a resident, then good luck getting out of it. What about the accounting period? We referred to that up top. Yeah. So what we mean by accounting period, broadly speaking, is often the same as the period of account. So, for example, a company makes accounts up to 31st of December. That's the accounting period. Okay. Now, it doesn't always have to be like that, because let's just say that you could have a long period of account. You'd have to split it into 2 accounting periods, because what we'll see is an accounting period, in other words, a chargeable accounting period, can't be more than 12 months. Okay? So we've seen assessable profits, we've seen accounting period. What about the basis of assessment for companies? Well, in essence, it's actual. So if you have a current accounting period, yeah, and you have actual profits within that period, then you're assessed to those profits. Okay? Now, in terms of differences between companies and individuals, I'm going to refer you as a self-study area to the study hub. Broadly speaking, there are a lot of similarities. You know, for example, adjustments to profits, you know, gains, etc., etc. Capital allowance is very, very similar. But there are some little nuances. Now, I didn't want to run through the list because, in essence, in terms of the differences, in the main, it's a rote learning exercise. Yeah? So what I would suggest that you do on this is have a browse through the list. And just note the key ones, in particular in relation to anything that relates to private usage, versus business usage. Okay? Next area for us is really the taxation of distributed profits. And let's be clear here, what we mean by distributed profits is that we mean a company is paying out, or let's say receiving, dividends. Okay? So in terms of the paying company, okay, we've got a company that pays out a dividend to shareholders. So in essence, when a company distributes profits by way of dividends, this amount is paid out of profits after corporation tax. Now this is an important point, because really what this says, but doesn't say, is that dividends for a company aren't tax deductible. In other words, they aren't like motor expenses or director's remuneration or stationery. They're paid out after corporation tax. So the distributions are paid out in effect net of corporation. That's an important point. It'll make more sense in due course. What about the treatment for shareholders, who receive a dividend from, let's say, this paying company? Well, as we know from our IT studies, basically dividends are taxed in their own column at various rates on a sliding scale upwards, depending upon the marginal rate of the taxpayer. Okay? In terms of companies, let's note this. This is important, okay? So let's just say we've got a paying company and we've got a corporate shareholder. So we've got another company that owns shares. These companies really have been receiving dividends paid out of profits, as we said up top here. So in effect, the dividend income for this receiving shareholder, as it were, who's a company, is exempt. In other words, it's not subject to corporation tax. So watch for this in the questions. Watch for the examiner giving you a scenario where there's a company that's received a dividend, okay, along with obviously trading income, interest income, property, and blah, blah, blah. The dividend is exempt from corporation tax. It's not taxable. End of story. It's already been taxed at source. Okay? Moving from there, in terms of this particular, again, another self-study area. I was going to say apologies. I'm not going to apologize for a self-study area because there's so much to cover within this syllabus. This area here is not complicated. For example, when they talk about employee remuneration, all that they mean is that employee remuneration, which would include directors, is a tax deductible expense. So when you look at it in a set of accounts, you'll see employee remuneration being deducted from revenue, or director's remuneration being deducted from revenue, etc., etc., etc. Okay? In terms of the loan note interest and in patent royalties, fairly straightforward. I'm going to refer you straight to the study hub. We've got bigger fish or more important things to do than to focus on that. Now, in terms of the computation itself, as mentioned, we have UK resident companies, being assessed to UK corporation tax on their worldwide income and gains. Okay? Now, for TX UK, we know that we're not going to have any overseas income. Don't worry about it. But in terms of a definition, this would be the definition. Okay? Outside of that, the computation itself, let me just go back a little bit, bear with me 1 second. In terms of the computation itself, I've got a lot of information on this particular page. Okay, so I want to make sure that you can see this and get this. Okay, so this is the first time that we've looked at a corporation tax computation for a given accounting period. Let's assume March 2024. So what you'll see, and again, as I've mentioned previously, it's basically a list. It doesn't get more simple than that. Now, I know within each of the areas, obviously, there are specific rules and nuances and tricks and traps and all the rest of it. But at the end of the day, what we're trying to do here up top is list all the various forms of income or profits for the company, getting to what we call total profits. Here, what we'll do is deduct QCDs, or qualifying charitable donations. More of that in due course. That will give us taxable total profits. So in essence, the top part of the CT comp is really based around populating for all income and just deducting QCDs. And then you get to what we call TTP. Okay? Now down below, and we know this is an area that the examiner is going to target, certainly in our TX exams for 24-25, i.e. FA23, because of the change in rates. Okay? So what we see here is the TTP and then basically tax calculated at the rate for the financial years. Okay? Corporation tax liability equals amount payable. Bang, we're done. Okay? But what we know here that this area for TX students has become more complicated because of this whole area of the marginal fraction, etc., and indeed the difference between the small companies rate and indeed what we call the main rate, or indeed large co rate at 25%. Okay, so as we move forward, watch for this area, because a pound to a penny, absolutely guaranteed. This is this area, literally, this little area here, it looks little, but it's a little bit complicated once we get into it. This is going to come up several times in your exam. Several times. I promise you that. Why? Well, because it tends to come up fairly regularly anyway, but the main reason, it's changed in this financial year. Previously, the rate, in other words, the CT rate, was 19%. That's it. Done. Out. Gone. Finished. Kaput. Now, there's several options. In effect, 3. Okay? More of that later. Okay? So, there we have it. We have sort of walked through, not in a massive amount of detail, but just to give you a feel for it. Just to give you a feel for what is in this corporation tax computation, and why does Paul say it's the simplest across the board in the 5 tax heads. Okay, so let's move from there. In terms of our basic rules of calculation, as I've just mentioned, that little area of the bottom of the CT comp is what he's going to target. So this particular section, although it says 2 rates, I'll explain a little bit further in a moment. In effect, there's sort of 3 main options. But in essence, when we think about a company, for the financial year 2023, they say 2 rates of corporation tax. So the small company's rate, 19%, if the company's augmented profits do not exceed 50,000. Now, I'll explain augmented profits in a moment, okay? Outside of that, they're suggesting a second rate, a main rate of 25%, where the company's augmented profits are 250,000 or more, the upper limit. So what we've got is a lower limit and an upper limit. You might want to call them the LL and the UL. Okay? Now, let's note, and I will explain this further, let's note that these upper and indeed lower limits are reduced for short accounting periods and also for the number of associated companies. Okay? Now, that's a lot of information for you to take in, I understand. Let me just recap to this point before we move on. We're looking at the area of what percentage rates do we apply to taxable total profits that we saw up top. And we're saying, or they're saying, that there's 2 rates, okay? I'm going to add another rate in a moment. But in essence, for the moment, let's just say, oh, well, if augmented profits, whatever they are less than 50, 19. If they're more than 250, then let's say 25, okay? My question is, what about in the middle? More of that in a moment. Here, in terms of this particular sentence, as it were, simply says that there's 2 scenarios, and both could be in play in one question, where these limits are reduced. The 50 and the 250. So imagine, we've got a company that's looking forward to paying tax CT at 19%. But someone tells them, hold on a minute, there's 2 associated companies, 2 companies associated with you. That means you've got to reduce the limit, which means that this goes down, which means they could be in to a higher rate. Do you see my point? Okay, so this area here, certainly a little bit complicated to understand right just now, but let's just try and make a note. Okay, the UL and the LL do get messed with, There's two things that mess with them. What are they? Okay, let's come back to augmented profits. Okay, mention them up top. They're mentioned here in relation to the 50 and here in relation to the 250. What do we mean? Well, we mean that the augmented profits are basically the company's taxable total profits plus dividends received, but exclude dividends from 51% group companies. So what do I mean by that? Well, let me go back up here. If I could find where I was, bear with me 1 second. Let me go back up here. I will find it, don't worry. If I go back to here. Yeah. So I just want to show you this one more time. We were looking at the CT comp. We said we get through the list down to here. So what augmented profits means is that we would take this number, taxable total profits, add in dividends received, but none from group companies, i.e. 51% plus, and then compare that figure, i.e. augmented profits, to the limits, the lower limit and the upper limit, noting that, as I've said, the upper and lower limits can be adjusted for short accounting periods. Let's say 6 months, then you're talking about 25,000 and you're talking about 125,000. Yeah? Okay, so they can be adjusted, but at the end of the day, what I'm looking to do to establish the rate, yeah, is to use augmented profits, not taxable total profits. Now let's move on to the sort of what I refer to as the sort of middle area, yeah? In other words, sort of the middle rate in one sense. Okay, this is the area of what we call, and this is new in FA23 for us, marginal relief. Okay, so what we're saying really with marginal relief in one sense is that it sort of deals with situations where companies have augmented profits, remember, taxable total profits plus dividends excluding group companies, between 50 and 250, because that wasn't dealt with above. We said below 50, 19%. We said above 250, 25%. So in this particular case, where the sort of in the middle, as it were, the rate of 25 is used, but this adjustment is made, yeah, in terms of the actual overall percentage. In other words, we apply 25% to TTP, but then take off this amount. Upper limit minus augmented profits times standard fraction, which is 3/200, by this fraction, the taxable total profits over the augmented profits. Now you'd be looking at this fraction thinking, what are you talking about? God, this is a nightmare. It's not too bad. It's not too bad. We have all of this information. We have it all. All we've got to do is slot it in. So we're really saying that when we do this exercise of looking at a CT comp and we see a company that where the the limits haven't changed, 50 to 50, and they've got taxable total profits, or so let's say augmented profits of 150,000, we know that they're a marginal relief company. So basically, we apply 25% and then deduct this amount. Okay? That's all we do. Again, it gets easier when we do questions. So this means that in effect, for me, there is actually, or technically, a third rate. It's the effective rate. In other words, it's the rate based on this adjustment. So if you will, we're talking about companies small, 19% up to 50, marginal between 50 and 250 based on this rate, and then outside of that, 250 and above, 25%. Okay, so when they talk in the hub about the effective marginal rate, they're simply talking about you could actually calculate the rate, but that's not relevant to us. You've never be asked for the rate itself. Okay, in terms of short accounting periods, I'm referring you to the study hub on this, on a self-study. Now, short accounting periods are simple enough for CT because we're simply saying that we have, let's say, a 9-month period, yeah, and as a result of that, the TTPs, or taxable total profits, are based on 9 months. That's it. What's the implications of that? Well, the implications are within the marginal relief area, yeah, for the reduction of both the LL and the UL. That's the main thing. Now, the next thing, and this is an area that I think the examiner could target, okay? The next thing is this area called accounting periods straddling 1st of April 23. Why is that date significant? Because in effect, 1st of April 2023 is the first day, as it were, of the new financial year. What does that mean? Well, I'll tell you what it means. It means that we may have to do a calculation between financial year 22 and 23. Why? Well, let's remember back to, if you will, if you've done any tax prior to this current exam, that financial year 2022, the rate of corporation tax, as I mentioned earlier on, was just 19%. That's it. Small, medium, large, don't care, 19%. But in this year, our year, we know that there's several possibilities, So in effect, what we're saying here is, if you have a chargeable accounting period that is in part, let's say goes back to, I don't know, let's say January 23, and the first 3 months, it's say December 2023, then you know that you've got 3 months that you must account for using the old rate and 9 months using the new rate, i.e. FA23. Now again, that's a lot of information for you to take in, unless you've really been through the ACCA Study Hub in detail. So again, as I say, don't worry too much, we'll pick it up. We're trying to build our CT house. In terms of associated companies, obviously, as we said up top, they're basically loaded or indeed shared, as it were. Okay? Now, let's note what we mean by an associated company. In other words, where we have a company that is impacting upon the LL of 50 and the UL of 250. We need to understand these areas because this could be someone, and I've seen this in OT questions, not so much in long form section C, but certainly in OT questions. Basically, we want a shareholding, of more than 50%. Okay, they're associated on that basis. Okay, and note these various little rules here. So, for example, dormant companies. So you could have a company that has the correct shareholding, but it's dormant. In other words, it's not trading, not carrying on a trade. They don't count. So they're not a company that I would include in my associated companies pot. Okay. Outside of that, where a company is, let's say, resident abroad, resident in Oompa Loompa land, they still count. I don't care that they're not resident in the UK. Okay, absolutely. I don't care where they're resident. If they are associated, they're going into my count of associated companies. Okay? And note also the first one here, I sort of jumped a bit there. If they're only associated for part of the counting period, it's taken that they're associated for the whole of that period. So this is a way of sort of clarifying, if you will, what's the number of associated companies? Because I know that they impact upon the UL and indeed the LL. Okay? So that's really part one for us. Now, a lot of information there for you. A lot of information, I understand. Okay? But let's just take it nice and slow. Let's do the questions and build from the ground up. Okay? Thanks for listening. Please do join me for